Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, the focus is on Nigeria's 2024 budget performance as of August 2024. The federal government of Nigeria recently published its medium-term expenditure framework (MTEF) and fiscal strategy paper for 2025 to 2027, which included the 2024 budget performance as of August 2024, 8 months. The budget implementation report enables us to assess how the government is performing relative to its prorated 8 months 2024 budget. The report shows that the federal government's retained revenue stood at 12.7 trillion naira, approximately 74% of the prorated budget of 17.3 trillion naira, translating to a shortfall of 4.5 trillion naira within the period. A further breakdown shows that oil revenue underperformed by 25% or 1.4 trillion naira to 4.1 trillion naira, accounting for 32% of total actual revenue. However, non-oil tax revenue outperformed at 3.8 trillion naira, 60% above the prorated budget of 2.4 trillion naira for 2024. Similarly, corporate income tax and value-added tax collections came in impressive with 1.7 trillion naira and 981 billion naira respectively, representing 74% and 55% above their respective prorated budgets. Similarly, actual independent revenue came in at 2.3 trillion naira, mostly transfers from government-owned agencies and ministries, departments and agencies (MDAs), outperformed by 28% or 504 billion naira. On the other hand, the federal government's aggregate expenditure closed at 17 trillion as of August 2024, 6.4 trillion lower than the prorated budget of 23.2 trillion naira. Further review shows that non-debt expenditure accounted for 29% or 4.9 trillion naira of total expenditure, 2.6 trillion naira lower than projected as of August 2024. Personnel costs, MDAs and GOEs, was 20% or 3.4% of total expenditure within the period. Debt service accounts for 44% or 7.4 trillion naira of total expenditure within the period under review. Aggregate capital expenditure of 3.6 trillion naira was weaker than planned at 40% implementation relative to a prorated budget of 9.1 trillion naira. The actual budget deficit stood at 4.2 trillion naira as of August 2024, based on total actual revenue of 12.7 trillion naira relative to total actual expenditure of 17 trillion naira. Here are our thoughts on the budget performance. 1. The impressive performance in oil revenue can be attributed to a reduction in oil theft, leading to an increase in oil production within the period. 1.57 million barrels per day in August 2024 supported revenue. The devaluation of the naira also boosted oil revenue in naira terms. 2. The increase in corporate income tax and value-added tax is attributed to higher prices of goods and services due to the rising inflation rather than a rise in business activities, as companies continue to struggle in a challenging economic environment with a high inflation rate and a depreciating currency. 3. The federal government's independent revenue improved significantly year-on-year and surpassed the prorated budget relative to previous years, where this line item has consistently underperformed. However, the federal government should be mindful not to turn MDAs to overly profit-oriented centers, as their primary focus should be policy formulation and implementation. 4. The total expenditure shows that the federal government spent less than projected due to weaker than expected revenue. Specifically, capital expenditure was at the receiving end, with the highest shortfall, 5.5 trillion, across the expenditure items. This happens yearly and is obviously responsible for the country's current alarming state of infrastructure development. Personnel cost is expected to increase total expenditure for the rest of the year due to the rise in workers' salary as announced by the President on the 1st of October 2024 with an effective date of September 2024. 5. Actual debt service as a proportion of actual revenue as of August 2024 stood at 58%, an improvement over prior years. This implies that out of every 100 naira revenue earned, 58 naira is used for debt service. This makes it challenging to finance obligations like non-debt recurrent expenditure and capital expenditure. 6. As we near the end of the fiscal year, significant borrowing is expected due to persistent gap between revenue and expenditure. This need for additional funds is likely to drive up interest rate in the bonds market as investors demand higher yields to compensate for the increased risk of lending during this period. 7. The government should actively consider a range of funding options beyond relying solely on debt to meet its expenditure needs. One viable approach could be to sell off underperforming or non-essential assets that no longer contribute positively to the financial landscape. Additionally, the government could look into reducing its stake in profitable assets, thereby generating immediate revenue while still maintaining some level of ownership and influence. By exploring these strategies, the government can enhance its financial sustainability and reduce the burdensome reliance on borrowing. Thank you for listening. Please join us same time next week for another exciting and interesting session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send SMS to 070-8246-3747. Stay blessed.